Mark Carney entered the 2025 federal election with a promise to restore economic stability and credibility. Having served as governor of both the Bank of Canada and the Bank of England, his reputation as a seasoned financial expert set him apart from typical politicians. Canadians, fatigued by years of political drama and economic uncertainty, were drawn to his message of professionalism and pragmatic leadership. Central to Carney's platform was the promise to negotiate a perfect deal in international trade, one that would protect vital Canadian industries, particularly agriculture and energy, while also expanding opportunities abroad. This deal was to reflect Canada's values and sovereignty, signaling a new era of firm but fair economic diplomacy. Carney's trade strategy was clear. He would not succumb to pressure from global powers, especially the United States, to accept terms that might undermine Canada's domestic priorities. His government emphasized maintaining control over sensitive sectors such as dairy and energy, ensuring they remained shielded from foreign competition. At the same time, Carney sought to promote innovation and investment by opening other areas of the economy to foreign partnerships. This delicate balance was meant to safeguard Canadian workers and producers while encouraging economic growth. His perfect deal thus promised principled negotiation without capitulation. However, this idealistic vision soon met a harsh reality. Enter Howard Lutnick, the newly appointed U.S. Secretary of Commerce and a titan of American finance. Known for his direct approach and business acumen, Lutnick quickly challenged Carney's position. He accused Canada of relying on outdated protectionist policies that hindered fair trade. Lutnick argued that Canada had long benefited from one-sided arrangements and needed to adjust to a world where economic relationships demanded mutual concessions. His criticisms publicly questioned Canada's willingness to engage in honest give-and-take. The flashpoint of tension was Canada's supply management system in agriculture, which protects domestic producers of dairy, poultry, and eggs through strict quotas and tariffs on imports. This system, legally entrenched and politically sensitive, was shielded further by Bill C-202, which explicitly prohibited Canadian negotiators from discussing supply management in trade talks. Lutnick and many U.S. trade officials saw this as a fundamental obstacle to progress. They argued it was unfair for Canada to demand access to U.S. markets while refusing to open its own, characterizing the stance as economic hypocrisy that could no longer be tolerated. Lutnick reinforced his position by pointing to recent U.S. trade deals with countries like Indonesia and Vietnam. These agreements required those nations to dismantle protectionist measures and accept tariffs in return for access to the vast American consumer market. According to Lutnick, the era of preferential treatment was over. Every country, including close allies like Canada, must adapt to this new competitive environment or risk exclusion. This put Carney's perfect deal strategy at odds with a global trend toward reciprocal trade frameworks that prioritize economic openness and balanced give and take. Back in Canada, the pressures intensified. Provincial governments, especially those of Alberta, Saskatchewan, and Ontario, expressed deep frustration with federal regulations they viewed as stifling economic growth. Legislation such as Bill C-69, which revamped environmental assessment rules, alongside federal caps on oil and gas emissions and mandates for net-zero vehicles and electricity, were blamed for deterring investment. These provinces argued that Ottawa's regulatory overreach was worsening economic stagnation and making Canada less competitive internationally. They insisted that unless the federal government addressed these issues, no international trade deal would be sufficient to revive the economy. Meanwhile, as other countries rushed to secure deals with the U.S., Canada's inflexibility risked marginalizing the country on the global stage. While Carney's stance resonated with Canadians wary of losing control to foreign interests, it appeared increasingly out of step with the world moving toward more transactional and pragmatic trade relations. Competitors willing to adapt quickly were gaining market access, investment, and economic momentum, while Canada's protectionism was beginning to isolate it economically. Lutnick's blunt message, that fairness in trade means all parties must share sacrifices, found an eager audience both in the U.S. and within parts of Canada's policy and business communities. He painted Canada's approach as anachronistic, arguing that expecting unlimited access to the U.S. market without opening domestic markets was unrealistic. This stance challenged Canada's historic role as a favored trade partner and pressured Ottawa to reconsider its negotiating position under threat of tariffs or exclusion. Despite mounting pressure, Carney doubled down on his commitment to principles. Recognizing the risks of prolonged negotiations, his government introduced domestic reforms aimed at breaking down interprovincial trade barriers and stimulating internal economic growth. Investments in infrastructure, digital industries, and regional development were part of a broader strategy to build resilience at home, ensuring Canada would not be wholly dependent on uncertain external deals. Carney framed this as a parallel track: strengthen internally while continuing to pursue a principled external agreement. However, skepticism grew about the feasibility of waiting for the perfect deal. Canada's economy was already near the bottom of OECD growth rankings, and investor confidence was shaky. Business leaders and economists warned that prolonged deadlock could cost the country billions in lost trade opportunities and capital flight. Critics suggested that Carney's insistence on an ideal deal risked slipping into inflexibility, turning what was meant to be strength into a liability in a competitive global market. Political opponents and analysts criticized Carney for lacking the political agility required for fast-paced trade negotiations. While his expertise in central banking was unquestioned, some argued he was slow to adapt to the evolving realities of international diplomacy. They pointed to the stalled talks, growing provincial dissatisfaction, and muted investor enthusiasm as signs that Carney's strategy, although principled, was not delivering timely results. This created pressure for a more pragmatic approach to salvage Canada's economic future. Ultimately, the standoff between Carney and Lutnick symbolizes a broader question for Canada's economic identity. Should Canada prioritize national sovereignty and protective values at the risk of economic isolation? Or should it accept the harsher realities of a globalized world where compromise and flexibility are prerequisites for prosperity? The answer to this question will shape Canada's economic trajectory for years, with millions of jobs and industries hanging in the balance. Canadians face the difficult task of choosing between principled steadfastness and pragmatic adaptation in an increasingly competitive global marketplace.